Happy New Year! I appreciate the opportunity to share a logical, data-driven, and simple way to accumulate equity using traffic lights from crystal clear indicator. Since the beginning of 2018, the market has been ascending wildly. Should I be bullish, bearish, enter or exit? This approach is the result of years of work and has helped me, and I believe it could help you to be rational and profitable in an irrational environment. Prior to going into the detail of the presentation, here the disclaimer. Traffic light and capital appreciation point are the results of proprietary risk analysis model and should be used as a part of your due diligence process. Crystal Clear Indicator is not a licensed financial advisor. Investing involves risks. In this session, we'll review the definition of preferred bullish trades and focus on the additional tool in Starter B subscription that could help you to generate 300% annual return. We will review a typical bullish pattern and discuss preferred bullish trades in depth. We will cover the definition of preferred bullish trades, the type, the characteristic, spike, and review sample historical return. We will also tour a Starter B subscriber area and the tools available to you. Here is my observation on the pattern of a bullish run in major indices. The event is like opening a new oil reservoir. When the reservoir pressure is strong, and oil will gush out. So there are two phases, the acceleration phase, shown here, and the taper phase. The strategies are different for each phase to achieve more gains. In the acceleration phase, the focus is on the directional trade. A person should focus on long-term allocation and leverage vehicle can be in place to build equities. In the taper phase, income strategy can be deployed. Traffic like Dow Jones and Nasdaq can help you to identify these phases, especially the acceleration phase. When preferred bullish trade occur, the expected gain is nearly 100% or higher with a certain investment vehicle. The downside is limited. To facilitate understanding, I illustrate an ideal simple preferred bullish trades with two synchronization on the right. The red dashed line here is the money in line. The green line here is the money exiting line or money out line. The orange line is the threshold line. The definition of preferred bullish trades is when the money in line, red dashed line, bottoms or near the orange line, or money out line, peak above the solid orange line. A synchronization is one of the conditions is met. The ideal graph here shows two synchronizations. Red line bottoming, green line peaking. If both traffic light Dow Jones and Nasdaq shows the same characteristic, there will be four synchronizations. The amount of bullishness is highly correlated with the synchronization. A preferred bullish trade could happen 2 to 3 times annually. Here is the actual screenshot of traffic light Dow Jones in 2011. I will use this example to discuss synchronized and non-synchronized in details. An example of a synchronized is in the green rectangle here. You will see that green line peak above the solid orange line and red bottoms below the solid orange line. There are two synchronizations here. If the same features reflected in traffic light Nasdaq, there will be 2 more synchronizations, and in total there will be 4 synchronizations maximum. A strong bullish should be expected with more synchronizations. In this case, it has a strong run. I'll show you the traffic light Nasdaq. Here again, the green line peak above the solid orange line and the red bottoms below the solid orange line. Let's switch gears and talk about opposite situation, not synchronized. In the pink rectangle in traffic light Dow, there was no synchronizations. Red dashed line did not bottom and green line did not peak. However, in traffic light Nasdaq, there was 2 synchronizations. The green peak above the orange line, the red dashed line bottom below the orange line. When there are less synchronizations, there are gains, but less than a synchronized situation. More importantly, in these particular examples, illustrate the importance of stop. When the appropriate stop is set, you could keep your profit and avoid unexpected downturns. Let's talk about the new tools in the starter B area. Daily traffic light Dow Jones and Nasdaq is available to you. A subscriber can view this data and that compose the traffic light Dow Jones and Nasdaq. The information is updated on a daily basis. The first column will probably be date, then there will be the Dow, ending of Dow, Nasdaq, then there will be the positions of each input. I'll go over some of them in details. And oh yeah, the money in line, right, the dashed line, money out line, the green solid line, that's for Dow and Dow money out. And there's Nasdaq in, Nasdaq out. And there's the orange line for Nasdaq and the Dow. And there's another support line for Nasdaq and out. And here, as you can see, I'll go in more detail in the next few slides, is how fast the slope is changing in traffic light Dow and Nasdaq. A subscriber will also have access to the chart. The chart reflects the daily data and provides historical performance of past preferred bullish trades. As you can see, the arrow here, 1, 2, 3, 4, identify bullish trades. And you can see what happened to the index when the preferred bullish trade happens. Okay, and you can see the gushes. The stock just jump when the trade started. And when the distance between the money in line and money out line is narrow, as shown here, it's also a bullish trade, it's just not preferred. Now I will talk more about detail in spike. Spike basically is the acceleration of a slope changes in traffic light. An ideal spike pattern is shown on the right. It is often observed that from bearish to bullish, pattern will appear this way. It will become pink, meaning the money flowing out will come to a halt, and there will be some neutral time of a blank situations. Then suddenly money will flow in, and that's when the preferred bullish trade starts. In this particular example was in August 30th, 2017. Let me just go back to one slide to show you where that is. It is right here. Here's another tool in Starter B, and it's a sample plan. And this should help you to facilitate the creation of your own plan to harvest the preferred bullish trades. The contents include investment vehicles, entry and exit rules for those vehicles, stop adjustments. The sample plan is a living document and will be updated with new material when appropriate. Here are some historical outcomes based on the sample plan. The information is organized in the order of synchronizations. More synchronization events are listed on the top, as you can see. More synchronized are on the top, more green here. The first column here is the date when a preferred bullish trade occurred. The second column is the duration of the trade. And the third column is basically the gain using regular ETF. No leverage, just ×1. The fourth column is using Emini as a vehicle. As you can see, the gain is nearly 100% when a preferred bullish trade shows up. This is the driver that could produce 300% annually. The entry and exit point for the regular ETF and the leverage is the same. The difference in gain is because Emini is a highly leveraged vehicle. As you can observe, more synchronization is highly correlated with higher return. Market cannot continue to go up forever. I also want to show you how to spot some bearish formation using traffic lights. Apart from the descending money line, which indicating the money is flowing out, the key is in preferred bearish trades to the rapid ascending green line. When the preferred bearish trade emerges, it is a good idea to tighten the stop of bullish positions. Here is an example of preferred bullish trades. Back in 2015, even before the index start adjusting, the green line already rising rapidly. It's a sign the market is heading for correction. Same thing again, after it rebounded for the first time, the green line ascend before the index drop. That's a sign that bearish position is forming, and stop should be adjusted for the bullish position. Now let's tour the Starter B subscriber area, and I will log in to the website and show you what you can have access to. Here's the website. You click login and type in your own login information, and your content should be able to access on the right hand side. And in my case, I'm a trial premium member, so I can have access to all. Now I just go to Starter B package. So now you are able to see the current traffic light on S&P 500. The information is updated on a weekly basis, and you can access to the old information as well. In the tutorial area, there's a sample plan. Okay, and if you click this link, the sample plan will show up. It will talk about sample plan statistic, what are the entry conditions, right, and exit conditions as well. So you have all this information to you. On top of the weekly information and the sample plan, you also have access to the data, and you can view them. They are the data itself right here, and most current is at the bottom. Okay, and for your reference, and traffic light did show there are some red money coming in, and when they have overlaps, there tend to be two fighting each other. And there's a whole graph of last 11-year data. There's a zoom in view of the data. Okay, that's what's happening. You can see the green line start ascending, and you see that for traffic light Dow Jones as well. Zooming of traffic light Dow Jones. Then you'll see the acceleration of spike. You notice that whenever the spike goes up as high, the green line will come down, and the red line will come down, the red line will start ascending. Okay, you can check that as a subscriber. So here are the summaries. We review the leading indicator, traffic light Dow Jones and NASDAQ, and we know that it can provide an intermediate view of the market direction. New tools in subscriber B area are based on systematic process and can offer a rational view to capture repeatable success. Starter B package includes all. I will say subscribe. Thank you for listening.